Hi, my name is Paul Drinkon with Prosperity Coaching Associates, and today I wanted to talk to you a little bit about a topic that this time of year I get more questions about than probably any other time of the year on a specific topic, and that is IRAs, Roth IRAs, putting money into retirement, etc. A lot of questions on how all these different products work. So I thought that I would take a little time here and basically explore the different investments that people have questions about, maybe explain some of these to you in a basic fashion, give you a better understanding of it. Basically, there's two types of money that you invest in, and those two types are qualified money and non-qualified money. Qualified money being any money that you put into a plan for retirement. Now, if you have, or at work, you perhaps have a 401k or a 403b. A 401k is that commercial companies, really it's just a tax code, and 403bs would be if you work for a nonprofit like a hospital or a school or a government. So there's really two different types of money, and the money that goes in these can be the same or they're identical, whether it's stocks, bonds, mutual funds, exchange traded funds, real estate investment trusts. Any investment either is classified as a qualified or a non-qualified investment. Qualified meaning that typically you've put the money in, it's lowered your taxes, and so you pay less tax now, and then it grows tax deferred. So when you get out to retirement, you pull it then, you pay the taxes in. And that's qualified money. Non-qualified money is any other money you might put into investment accounts, again, mutual funds, stocks, bonds, etc., that you've invested in after taxes, and so you can utilize it at any point in time, and there's no penalty. Typically, the qualified money, if you pull it early, you got to pay a penalty of typically 10% to the government. So qualified money, qualified money. The investments are identical. It's just whether it lowers your taxes and you pay it later, or you can use it now. And the other question involved with this that I get all kinds of questions on is, Paul, what's these IRAs and what's Roth IRAs? What's the difference, and can I invest in them? Really, the difference is fairly basic. An IRA is very similar to the 401k. You can put money in, it lowers your taxes, and you pay it later, unless you have a 401k. I should say one thing. Every person, every investor gets one account that they can invest in that lowers their taxes. So if you're at work and you put money into a 401k or some type of retirement plan, it lowers your taxes. If you put money into an IRA outside of work, which you can do, it will not lower your taxes. That's why if you qualify an income level, then the Roth IRAs really make sense. So back to the difference between a regular IRA and a Roth IRA. A regular IRA is tax, you put the money in, you invest, and it's tax deferred. Again, you pay the taxes later. When you retire, you pull the money out, you pay it at your tax rate at that particular time. A Roth IRA, on the other hand, is after-tax money. You've already earned it, and you've got it, and you invest it in a Roth. The Roth grows tax-free. In other words, if it's 10, 20, 30 years, if you invest and you put in a Roth, it's there for 30 years, and it compounds and is worth a substantial amount of money. When you're in retirement, you can pull that, and it does not go towards your income levels. It is tax-free. Roth's tax-free. Regular IRAs, you pay the tax later. That's it in a nutshell. I hope I haven't confused even more, but certainly it is a confusing topic at times for people. So if you have more questions or would like to sit down and talk about it, give me a call at any time. I'd love to sit down and talk to you about Roth IRAs, and your investments at work, how they apply and really coordinate with doing IRAs and Roth IRAs. Till next time, thanks for coming to Prosperity Coaching Associates.